I'm Anthony Valeri, Director of Investment Management in Wealth and Fiduciary Services. Today, we'll take a look at whether it still pays to diversify if you're an investor. 2022 has gotten off to a tough start with both stocks and bonds down in January and lower so far in February. Now let's take a look at this and see whether it really does pay to diversify or whether an investor would be better off with a different strategy. Now, getting back to whether bonds still make sense as a diversification tool, we can look back at data to show that although both stocks and bonds are down, it is rare, but it does happen. This table shows monthly total returns of both stocks and bonds as measured by the S&P 500 and the Bloomberg Aggregate Bond Index. Roughly 20% of the time, both stocks and bonds are down. In other words, diversification at a high level between stocks and bonds fails investors 20% of the time. We looked at quarterly data and came up with a similar percentage. So again, although rare, it does happen, but we wouldn't abandon using stocks and bonds together. In fact, in the current environment, the bond market has priced in 6 interest rate hikes from the Federal Reserve, and those interest rates have moved up in anticipation of that. So we think the worst may be behind bonds, and note that historically you can still make money in bonds with rates rising. So we would still use bonds in a diversified portfolio, but note that time to time diversification can fail. Now, let's take a close look at diversification within the equity market. Now here, diversification has failed and failed for a number of years, and we'll look at several components within the equity market. The first is looking at U.S. versus international stocks, and we're looking at the 5-year rolling cumulative total return between large cap U.S. and international stocks as measured by the MSCI EAFE. At the top, you see that U.S. stocks are outperforming international by a substantial margin, just over 50% cumulative over the last 5 years. You'll also note that this has been going on for some time. This is an extended run of outperformance of U.S. versus international. But if you look back further in history, in the 2000s, international outperformed the U.S. steadily from the peak of the dot-com bubble in late 99, early 2000, all the way through 2008. Important to note that these diversification trends can be multi-year trends. The current one is certainly extended, and we wouldn't try to chase U.S. large cap stocks despite this outperformance. In the 80s, which is not fully shown here, international had a very strong run of outperformance relative to the U.S. So these trends can persist, but it's important to be diversified because we don't know when they will reverse. And so far in 2022, international has outperformed U.S. Let's look at another aspect of the market, large cap U.S. versus small caps. Here too, a significant period of outperformance of large caps relative to small caps. You can see that it is also near a 50% gap here on a cumulative basis. That's the largest since the late 90s and also the dot-com bust. Small caps have had their moments over the last 10 years, but here too, an extended run of outperformance of large cap stocks. Let's take a closer look within the stock market, looking more at style rather than geographic location or market cap segment. Here we're looking at large cap growth versus large cap value. Now, your growth stocks are typically your faster growing companies. They tend to have higher valuations. You'll see your technology companies well represented in this style. Value is your more companies closer to intrinsic value that include companies from energy, financials, and consumer staples. Here too, an incredible run of outperformance from growth relative to value that traces its roots all the way back to 2005. There's been some mixed performance in between then, but it has been a significant run of outperformance on growth relative to value. However, as you see on the far right of this chart, value has outperformed over the last 2 months ending January, and it has been a sharp and quick move. The degree of prior outperformance of growth suggests there's much more room for this trend to continue. And again, we would not chase large cap growth outperformance. It's just important to realize how quickly these trends can change. They are multi-year trends and they do work. They go in both directions. Important to stay balanced so you don't chase what has worked in the past for what could be a change going forward. Important to have that balance in the portfolio and include value should this trend continue. Now, why is this important? Now, if we look at the S&P 500, it is very concentrated. The top 5 companies are almost 25% of the overall index. Not shown, but it's the largest weight of the top 5 since the early 1980s. So again, historically, we have a very concentrated S&P 500, and rather than chase those big companies, the big tech companies, the FANG stocks as they're called, to chase that performance, we think now is not the time to do that and maintain diversification. Now let's take a look at numbers to prove this point over the longer term, and it really helps to have a long-term view, actually a very long-term view. If we look back at the start of the 2000s and went through that decade, an investment of 100,000 in the S&P 500 would have declined 9%. Now keep in mind those are two difficult points for investors. 2000 was near the peak of the dot-com bubble, and then 2009 was end of 2009, not far removed from the end of the financial crisis. You can see the S&P 500 declined, whereas the diversified portfolio, which includes not just the S&P 500, but also international, emerging market equities, and mid and small cap stocks, outperformed. Now, fast forward to the 2010s, and we saw strong outperformance of the S&P 500 relative to the diversified portfolio. In gold, you'll see the dollar amount of that $100,000 investment still in favor of the diversified portfolio, but pretty close. The last 2 years, 2020 and 2021, have seen continued strong outperformance of the S&P 500, and that has enabled the S&P 500 portfolio to pull ahead, but that gap of just over 10,000 is fairly narrow. So we still think it makes sense to stay diversified. It's not worth chasing that concentration, that single market segment, and we think over time that diversified portfolio will continue to benefit investors and smooth out the ups and downs over time. I'm Anthony Valeri. Thanks very much for joining. We'll speak to you again soon.